Vallabh Bansali of the ENAM group.
The fiscal discipline, which is the glide path to fiscal, how quickly we have gone from 5.9% to now talking about 4.5% fiscal deficit next year. And how feasible this is. If the occasion arises, I can talk about it. The rating revision that we have had recently, and how this all, and the reduction in vulnerability index, the reading is continuously coming down at a very difficult time in the world. All this in the context of India, according to me, is leading to the best rating. Technically, it may be called whatever. And therefore, it was very important for us that India, as a prime destination in the world, should not lose its perch while you have to do what is politically right and what I think even from equity point of view is right. Let me just illustrate. Say we have about $120 billion of remittances. We have about 300 odd billion dollars of software exports and services exports. We will have, anyway, it's too early to say, but 40 to 60 billion dollars of inflow on account of bonds from JP Morgan, Bloomberg, etc. All this gives us serious fiscal stability. The second thing that you will see probably, this is my guess, is serious effort to reduce the cost of capital in the country. So inflation has been controlled. Our worry about inflation that, if oil prices go up, if we have to import fertilizer, etc., with all this fiscal stability, with boost in revenue, we are in a position now to attack cost of capital. The CRR at crazy 4.5% can easily be knocked off by 200 bips. And therefore, what you're seeing, banking stress, deposit mobilization, etc., has to be decomposed. And if you look at several macro factors that are being guided, managed, understood, taken advantage of, you are seeing a picture over the next 2-3 years of India really becoming a fantastic destination. And therefore, reforms that were not feasible in keeping in view the cost of capital, fiscal uncertainty, etc., that big chapter of reforms is going to unfold.
Mr. Bansali, when the para 1 has been written and the next budget is less than 6 months away, is this some kind of a hint or indication that equity as an asset class will no longer get preferential benefit? Because the data also is indicating that the total exposure of Indian household into equity is less than 7-8%, which means equity as an asset class, perhaps in terms of participation from Indians, still has a long way to go.
See, there is no absolute number which can be targeted. As the society evolves and as the income distribution flattens, the income distribution is flattening, but nowhere near where it is desired. And therefore, we have to lift all the 40%, 50% of our people to 2 times, 3 times per capita income. And then we could probably look at numbers like 15%, 20%. So it's a process. And as I said earlier, we should not look at this tax incentive as the only incentive for capital markets. Capital markets are the most quick representation of changes that take place in the economy. That feature is not going to go away. And therefore, capital gains taxation in different countries is at different levels. So we had, at one point of time, we needed to bring a lot of money into equity markets. Equity markets are today, more than one time GDP in valuation. We are amongst the most expensive markets in the world. PE multiples for most sectors are probably 40% to 100% premium to their 3-year average and so on. Therefore, the equity markets can take a little breather. But as other features, the macro features of the economy stabilize, they will also become a pointer to come into capital market. So the habit of getting into the habit of getting into pensions, getting into etc., is not going away. And therefore, every time a direct tax change related to the capital market happens, there is the knee-jerk reaction. Oh, we are no more the preferred child. You are the preferred child because of the fantastic work that has been done in the country in regulating capital markets. Between SEBI and between other bodies, we are a fantastic market, well-functioning, and then the whole macro structure for our capital market. SEBI is talking of further reforms on IPOs, etc. So you'll take a breather. Primarily, you would agree with me that the levels at which our market was trading, they were due for a correction and a pause. We at the most get a pause, but the trajectory, as I said, I've looked at much higher taxation on capital gains and things like that. We have moved on. Even within this, if you see the sensitivity, so the buyback provision, people are still trying to figure out, but they have moved towards an equitable position. That company taxing buyback was just not correct. Now they have moved it to the hands of the recipient. And therefore, while all this was being done, there is sensitivity to how this should be done. I think today where we are, in a country where a lot of people are still not at very respectable levels of per capita income, paying 15% tax is not a very high rate. If those who would have money and have capital do not want to participate, they want to remain privileged all the time, I don't think that's fair. And it is not going to make any major difference to the flows in the market on a medium to long-term basis. I have zero worries. I'm very happy having to pay a little more tax on the gains.
Mr. Bansali, the second part of your answer was that the blueprint for the next stage of reforms are getting ready. And I would like to remind our viewers that in 2021, Mr. Bansali, when he graced the channel, he said the following, that India has 3 balance sheets: retail, rock solid; corporate, which is getting solid; and government, which has been stronger than ever. And then we've seen a huge recovery in earnings, and India's moment has arrived. So based on what you shared with us in 2021 in terms of an insight, what is the next insight you would like to share with our viewers in terms of what would be the next sector or next set of reforms?
Well, you couldn't have set up the question better. The next is that if India today is the third largest economy, practical purpose, it happens in a few years. On a PPP basis, we're already there. What next for us? There is this whole larger macro reality that as the Western world and China want to prevent each other's entry into their markets, both of them are going to look for a large market to capture. That market is India. Now, we have a threat of being colonized either by the West once again, or by the East, or by China. And what are we doing about it? That can happen only if we take bets for the next 10 years, 15 years, 20 years. It's not going to happen easily. Say, for example, take a state like Andhra Pradesh. Chandrababu Naidu, more than 20 years ago, visualized that, oh, why Hyderabad can't be better than Bangalore as a IT hub? He visualized a next airport, highways, there's an electronic park, metro. It was unthinkable at that point of time. But over the next 5-7 years, the state got huge benefits. Today, we have to think of research and development, of productization. Today, they have talked about that private sector innovation using 1 lakh crore fund of government funds. The finance minister didn't talk about too much about it because I think they're still working out the fine print. But they did talk of that, okay, we have to be a research-led, prototype-led. We need a lot of ecosystems to get better at creating our own manufacturing supply chains. Otherwise, we'll become a colony of China and the West. This is the foundation that is being laid for a Viksit Bharat by 2047. And for which cost of capital has to come down, private sector and public sector partnership has to happen, public resources for private-led research, production. So the PIL chapter number 2, chapter number 3 have to be written. And in this budget, combination of digitalization, combination of government funds, identification of those who can work with the government. Today they talked about agri-research. So slowly we are moving towards a research, technology-led, and taking advantage of digitalization.
Just one last follow-up question, something which in a sense everybody is trying to understand and we perhaps would seek your guidance. There have been two events which have not been so much so which one would say markets were prepared for. First, the election verdict, markets were prepared for a complete majority, that did not go through. Second, today, changes in the tax structure which frankly markets were not prepared for in this budget. But markets are exhibiting resilience. Bad news has been ignored, declines have been bought, and the comeback in the market has been powerful. Is that maturity of the market, or this is complacency and liquidity which is at play?
Not at all. I think it's very difficult to say what has gone into the market. But clearly, I think the markets have been maturing, that we have seen again and again that the retail investors' mutual fund behavior has been very, very mature and solid. And therefore, it could be that. But there is no reason. See, if I make profit and I pay a little tax or a little more tax, makes no difference. Making profit is not easy. As long as the profit-making potential of our assets, of our country, of our companies is only being enhanced, whether you pay small fraction or a slightly bigger fraction makes no difference. अरे भाई कमा के टैक्स भर रहे हो ना? That is the fundamental thing. And I think the market is mature enough to recognize that. And in the context of our social milieu, how much money people have made in the market. And today, when you will see this land and gold and other things being brought in, I think what is the message? Message is that diversify now, which is a good thing. And we will need lower land prices as the land becomes more liquid. That is the biggest component of real estate. So this freeing of land, and as I talked about digitalization of land title, etc., which will happen over a period of time, I think you will see lower real estate prices and therefore bigger boom in the economy. I think there are a lot of experts who know India well, and therefore I'm not surprised with this. But market could take a breather, but so what? We have had a run for a very long period of time. So even if it did, I think it's no worry.
If you like this video, then like, share and subscribe to ET Now.